So we have in accrual accounting, we have deferrals and we have accruals. Deferrals means paid in advance. Accruals means paid later. Yeah, paid in advance versus paid later. From the company's perspective, this is the prepaid expense is an outflow. Yeah, outflow paid in advance. Outflow. And the prepaid expense is an asset, yeah, because the company has the right to use the building or whatever. It's prepaid rent. Unearned or prepaid revenue. This is an inflow. So this is an inflow. And this results in a liability. Yeah, this is unearned revenue is a liability. Accruals, for accruals, it's the other way around. It's paid later. Yeah, paid later. And accrued expenses. This is a liability. So accrued salary, for example. This results in an outflow later, yeah, because the salary eventually it has to be paid. Yeah, accrued revenues. Here we're talking about accounts receivable, for example, and these are assets. And they result in an inflow. So deferrals again means in advance, yeah, paid or received cash in advance for the business. Business paid or received cash in advance, and examples are unearned revenue, which is a liability because the company later has to perform the service and earn the revenue, and prepaid expenses because the company has already paid for it, but resulting from the payment, it has the right to use the asset, and the right to use the right to use the building is an asset. Yeah. So unearned revenues, liabilities, prepaid expenses are assets. Does that make sense so far? Does that make sense? Or are there any questions? Clear. Okay. All right. So here we have the related journal entry. Prepaid expenses, for example, prepaid rent. The firm pays in advance. Prepayment results in an asset. The firm has a value, and this is worth something. What to use the building in the future for future periods. Yeah, and the related journal entries are, and you debit prepaid rent. This is debit. Debit. You debit prepaid rent, and you credit cash. You credit cash. So this is prepaid rent is an asset, and one asset increases. So asset up. And cash, what is cash? Is cash also, what kind of account is it? Cash is also assets, yeah? So one asset up and one asset down. Very good, very good. So I see you understand it. One asset down. Rent expense. This is when the prepayment is made, when the payment is made. When the company later uses the the building or whatever, then it has to book a rent expense. And rent expense means this is an expense, and expenses decrease equity. Yeah, the expenses flow into the income statement, and the higher the expenses are, the lower is our net income, and the lower is our equity. Yeah, so expenses decrease our equity, so equity is down, and prepaid rent is, what is it? What is down here? It is asset again. Yeah, asset is down. Asset. Exactly. Very good. So, and you see here the accounting equation is always balanced. Yeah, it's balanced. One asset up, one asset down. Makes sense. Yeah, 1,000 up, 1,000 down. Here, rent. By the way, this is the accounting equation. Assets equals equity plus liabilities. So for the first journal entry, we have one asset up, one asset down. For the second journal entry, we have one asset down, and equity down. Yeah, so this is this, and this is this one. Yeah, makes sense? Are you with me? Yes. Okay, cool. This is the journal entries for unearned revenues, also called deferred income. Yeah, deferrals means paid in advance. Yeah, here the firms collect the cash in advance before earning the revenues, and that's why they have a liability. They have a liability. Liability is they are obligated to perform the service. Only when the job is completed, let's say the shipping is done or whatever, the firm earns the revenue. Yeah. So what are our related journal entries here? Again, let's do our accounting equation. Assets equals equity plus liabilities. What is cash? Can you tell me what is cash? It's cash asset, equity, liabilities, asset. Yeah. So if you debit an asset, it goes up. And unearned service revenue. What is unearned service revenue? Unearned revenue. Is it an asset? Is it equity, liability? Exactly. Yeah. So asset up, liability up. That makes sense. Yeah. Good. Then this was our first journal entry. When the payment takes place, yeah, cash goes up, but the firm has to record an unearned service revenue. The second journal entry is when the firm actually performs the service. When the firm performs the service, what do I have to write here? If unearned service revenue, if I debit unearned service revenue, this is debit, it is a liability. Yeah, you already said that it's a liability. And does the liability go up or down here in the second case? Liability goes up, yeah, and it goes down. Sorry, you're right. And equity goes up. Yeah, very good, very good. Yeah, equity goes up because service revenue increases our revenue, increases our net income. Yeah, it flows through the income statement and eventually increases our equity. Very good. So this is the second. Yeah. Accruals are when the expense or revenue occurs before the payment. Yeah. In the case of salary expenses, yeah, you record the expense and you later pay for the expense. Accounts receivable, you record the revenue and the customer later pays. So here we have our related journal entry. In the case of an accrued expense, yeah, let's say an employee works before the salary payment takes place. Yeah, so the employee works, the firm has to record an expense, but it does not pay yet. Again, let's write our accounting equation. Assets equals equity plus liabilities. So here, what do I have to write? If you debit salary expense, what is it? Is it related to assets? Is it related to equity, to liabilities? I have an expense. Equity down, yeah, and liabilities up. Very good, Raychan. Okay, and then the second journal entry is when the payment actually takes place. Yeah, before the firm has a liability. Yeah, liability means the firm has to pay. Yeah, and this is the second journal entry is when the payment actually takes place. And so here, what do we have to write here? Okay, Ray Chan has also already written asset is down, yeah, because we pay cash, and liability is also down. Exactly. Yeah. Good. Salary payable is a liability and the cash is an asset. Correct. Yeah, very good. Here we have accrued revenues, assets. When the firms earn the revenue before the cash is coming. Yeah, we're talking about accounts receivable here. So what do we have here? Assets. Again, our accounting equation. Which elements of our accounting equations are affected here in the first instance? First journal entry, when the firm records revenue and records an account receivable. Account receivable, is it an asset? Is it equity? Is it a liability? What do you think? Asset up, equity up. Good. Account receivable is an asset, yeah, because the firm with an account receivable, the firm has the right to receive the money in the future. And service revenue is revenue, goes into the income statement and eventually increases our equity. Very good. And then our second. What do I write here? Cash and accounts receivable is affected. Account receivable is an asset. Cash is also an asset. Which goes up? Yeah, cash goes up. And accounts receivable, which is also an asset, goes down. Yeah, you see, accounting equation in both cases is in balance. Yeah, first case, asset up, equity up. Second case, asset up and another asset is down. So here we're talking about the depreciation of fixed assets. Yeah, fixed assets are long-term assets, and over time, the value of those fixed assets goes down. Yeah, over time, the value of those fixed assets goes down, and the depreciation is there to allocate the expenses over time. Yeah, to spread the expenses. Yeah, first of all, when we buy the equipment, yeah, it can be bought with cash, but here it is called on account. Equipment goes up, or property, plant, and equipment, whatever it's called, and the account payable goes up as well. So let's do our accounting equation. Yeah, Ray-chan says asset goes up and liabilities goes up. Okay, I'll do that. Liabilities goes up. And in the second journal entry, here we actually record the depreciation expense. So what do I have to write? What do I write here? An expense. What does an expense do? What element does it affect? Depreciation expense. An expense decreases our equity, and exactly, Liang, very good. Asset goes down. Yeah, accumulated depreciation is an asset. More specifically, it's a contra asset. Yeah, it is a contra asset, and it reduces the book value of the asset. Yeah. So again, yeah, our accounting equation in both cases is in balance. Generally, there are three different ways of depreciation. Yeah. So the first is a straight line depreciation. It goes like this. Yeah. So the same amount in every year, kind of. Double declining balance method means that actually you have, this is a sort of an accelerating depreciation method. So it starts with a higher depreciation per year, and then it kind of levels off. Yeah. And then we have, as a third depreciation method, is that we have the percentage of completion. And the percentage of completion method, it depends here, the depreciation depends on the progress. Yeah, when it is a little progress, or when it's used a lot, used a little, then it is only tiny. But when it is used more, then the expense is higher. Yeah. So here this is the percentage of completion method depends on the usage. In accounting, we have permanent accounts and we have temporary accounts. What is the difference? Assets, liabilities, and equity generally are permanent accounts. Generally, yeah. So we can generally. Generally are permanent accounts. They must not be closed at the end of the period. What does that mean? They must not be closed. They carry over. Yeah. So what are examples for asset accounts that carry over? We just talked about cash. Yeah, cash carries over for the next period. That means that the ending balance of one period is the beginning balance of the next. Yeah, the ending balance of one period is the beginning balance of the next. Yeah, liabilities, also accounts payable, for example, or equity also carries over. Yeah, think about share capital or something like that. Yeah, so these are permanent accounts and they carry over. Temporary accounts, this is the opposite. And temporary accounts, they need a closing process. What does closing process mean? They cannot carry over. Yeah, they do not carry over. They start with 0 at the next period. Yeah. So, for example, income and expenses. Yeah, they relate to a limited period. Yeah, typically 1 year. And that's why they are called temporary account. A dividend account is also a temporary account. It is only for 1 period and has to be closed. Yeah, it does not carry over. So closing entries transfer balances of revenue, expenses, and retained earnings. Yeah. So for these temporary accounts, they have to be closing entries. Yeah. So they transfer the balances into retained earnings, and then they start with these accounts start with 0. Yeah. That is also why I say that they are essentially equity accounts. Yeah, revenues and expenses are essentially equity accounts. Why? Because their balances go to retained earnings. Yeah. Yeah, of course, they are summed up in the income statement, but nevertheless, they increase retained earnings. Okay, Then we have a couple of exercises. Let's take this one. If a real estate company fails to accrue commission revenue, revenues are understated and net income is overstated. Is this correct? Or is it assets are understated and net income is understated? Or is it net income is understated and shareholders' equity is overstated? Or is it liabilities are overstated and owners' equity is understated? What do you think? What is the correct answer? Think about it. If a company fails to accrue revenue, think about it. When a company fails to accrue commission revenue, don't know. When there is revenue, but the company doesn't book the revenue. When there is revenue, actually the company should book revenue, but it doesn't book revenue. So revenue increases net income. So net income is understated, yeah, because revenue is not booked. Net income is understated, and assets are also understated because accounts receivable are also too low. Accounts receivable are also too low, or cash, whatever. Yeah. So B is the correct answer here. Assets are understated and net income is understated. Do you understand why? The company fails to accrue revenue, fails to book revenue. And when a company fails to book revenue, assets are too low, yeah, because there have to be accounts receivable. And net income is also too low because the company should have booked it, and the company has not booked it. The next one, on a trial balance, which of the following would indicate that an error has been made? Which one is wrong? Accumulated depreciation has a credit balance. Salary expense has a debit balance. Service revenue has a debit balance, or all of the above indicate errors? Which of the following would indicate that an error has been made? Let's go through the different through all the answers. Accumulated depreciation. Accumulated depreciation is a contra asset account. Yeah, it's an asset, correct? It's a contra asset. And so generally assets have debit balances, but because we're talking about a contra account, credit balance is correct. Yeah, credit balance is correct. Salary expense has a debit balance. Salary expense is an which account? It's an expense account, and expense accounts carry debit balances. Yeah. C, service revenues has a debit balance. Is this correct? Think about it. If you're talking about revenue, Ray Chan says no, which is true. So C, service revenue has a debit balance. If that is the case, then an error has been made. Yeah, because revenues do not have debit balances. Expenses, all the expenses, yeah, so these are expense accounts. And so expense accounts, they have whatever, yeah, they have debit balances. They have debit balances here. Revenue accounts, they have credit balances. They have balances. Yeah. Asset accounts have debit balances. Liability accounts have credit balances. Yeah. And equity accounts, normal equity accounts, where do they have their balance? Credit or debit? Credit. Yeah. Yeah. So salary expense is an expense. Debit is correct. Yeah. Accumulated depreciation has a credit balance. It's an asset, but it's a contra account. And contra accounts means it is a minus. Yeah. So, for example, it reduces the book value of the asset. That's fine. Whatever. So it has this is a contra account here. It goes in with a minus. That's why credit balance is correct. Yeah. And service revenue, here we're talking about revenue. They have a credit balance and not a debit balance. Yeah. So debit balance is wrong. Yeah. If you do not know, sure, if you have problems with that, you can go back Now we can go back. And here you see it, for example, yeah. So in the cash is an asset, you debit it for increase. Yeah, you debit it for increase. Share capital, equity, you credit it for increase. Yeah. Yeah. Asset, you debit it for increase, you credit it for decrease. Liabilities, the other way around. Yeah. You debit them when they decrease, and you credit them when they go up. Yeah. So these accounts, asset accounts, have a normal debit balance. Yeah. Normal debit balance. Yeah, because debit is up. Liabilities account, they have a normal credit balance. Yeah, normally they have a credit balance because this is up. Yeah, equity is credit balance because it's up. If we're talking about normal equity accounts, because there are also accounts, equity accounts, which are the other way around. The first three, the top three, are normal equity accounts. Credit balance, yeah, credit balance. Retained earnings, credit balance. Income accounts or revenue accounts, credit balance. Credit them normally. They have a positive sign. Then that means they have a credit balance. With dividends, it's the other way around. Why? Dividends is a contra account. It reduces our equity. That's why it has a debit balance. Debit goes up. Yeah. Or expenses is also a not normal equity account. So it has a debit balance. Oh, where are we? Okay. The account unearned revenue is an asset, an expense, revenue, or liability. What do you think? For this one, what is correct? Is unearned revenue an asset, an expense, a revenue, or a liability? What is unearned revenue? Is it an asset? Is it an expense? Is it a revenue, or is it a liability? If a company gets the money up front, but has the obligation to perform the service later, it gets the, let's say, the company that sells the tickets, it's a liability too. Very good, yeah. it's a liability. Yeah. Because the company has the obligation to perform. Which of the following accounts is not closed? If you remember, we have permanent account and we have temporary accounts. Yeah. So the permanent accounts, they are not closed. The permanent account, they carry over. The temporary account, they are closed. So which is not closed? Which is a permanent account? Which of those? Is dividends closed? Exactly, Liang. D is the correct answer, because all the others have to be closed. Yeah, all the expenses have to be closed, all the revenues have to be closed, and dividend is also an account which has to be closed. So accumulated depreciation is correct. Yeah, again here. Income and expenses relate to a limited period, and they are called temporary accounts and have to be closed. Yeah, and dividend is also a temporary account. Yeah. Very good. Okay. Let's do a break here.